Do you sometimes sell your personal non-business assets? Well, then you should watch this video and learn how to record the selling of non-business personal assets. If you have any questions about this topic, you can leave them in the comments section below and I'll do my best to help you. And of course, if you feel the video helped you, I hope you will click like and don't forget to subscribe to get updates on new videos that come out all the time. When you sell a non-business asset, you must compare what you originally paid for the asset to what you are getting paid for the sale of the asset. If what you originally paid for the asset is more than what you got paid when you sold it, then you have a gain. However, if what you paid for the asset is less than what you got paid for the asset, in that case, you have a loss. Now, what type of accounts in the chart of accounts would be a gain or loss from the sale of an asset? Well, the gain on a sale of an asset would go in your chart of accounts as an other income type of account. It goes at the bottom of the income statement after net income from operations because it does not reflect how you would normally operate. That's because you're not really in the business of selling these assets. You must include in taxable income if you have a gain from the sale of a non-business personal asset or any kind of personal property. The capital gains are calculated differently on the tax forms than in QuickBooks. Separating them by making them an other income type of account will help you file your taxes later. However, a loss on the sale of an asset would go in the chart of accounts as an other expense type of account. It goes at the bottom of the income statement after net income from operations because, again, it does not reflect how you normally operate. You're not in the business of selling your personal assets. Please note, a loss on a sale of a personal asset that you're not using for business is not deductible. It is not deductible if you have a loss on selling personal non-business property. For example, let's imagine on November 1 of 2016, we sold the electronic bike for $4,000. So, if the balance of the bike is $3,000, because that's what we originally paid, then we have a gain on the sale of $1,000. So let's first create the gain account before we record the sale. From the top left, we click List, Chart of Accounts. In the bottom left, we click Account, New. Now the type is not income. The type is other income because it's not part of the income that you earn from the way you would normally operate or work on your jobs. We then click Continue, and we're going to name it specifically for that asset. Gain on sale of bike. Save and close. Now we can record the transaction and we'll take a look. We're selling it for $1,000. Now, when you sell, what will be the result? Well, cash goes up to $12,681 because cash will be $4,000 more than it is now because we just got $4,000 for the bike. Electronic bike becomes zero because we just sold it and it should have no value in our books and records. And the gain from the sale of the bike should show up for $1,000. To record the sale of any asset, you must make a journal entry. and we will not discuss the concept of debits and credits. I'm just going to give you a small piece of advice to follow, and you can use this video as a guide to know exactly what to debit and what to credit if you are selling one of your assets. So it's very simple. We close this out and we look at the trial balance. Now the debit and credit idea is very simple. If an account is normally on the debit side, you would put it as debit in the journal entry if you want to increase it, and you would put it as credit in the journal entry if you want to decrease it. And the opposite would be true for an account that's normally on the credit side. If an account is normally on the credit side, you would increase it by putting it as credit in the journal entry and putting it as debit if you want to decrease it. So simply watch the pattern of the debits and credits and repeat these steps as you see them if you're selling an asset. From the main menu, we click Company, Make General Journal Entry. Now first, you have to make sure that you remove the check mark and that the check mark is not checked in the box that says Adjusting Entry. This is not an adjusting entry, it is an actual transaction. And the date of the transaction in our little story is November 1st of 2016. The first line that you click is Account. Click the pull down, and first you choose the bank account that the money from the sale went into. And you choose Chase Bank. Now, Chase Bank is an asset that normally has a debit balance. So to increase an account that has a debit balance, we make more debit. And the account is increasing by $4,000. Now, if you keep pushing the Tab key, QuickBooks moves to the next line, but it doesn't know that there are 3 accounts in this transaction, so it's trying to balance the entry. Let's remove the $4,000, and on the next line, we'll actually choose the electronic bike. Now, electronic bike currently has a debit balance, and we're trying to wipe out and remove the debit balance. So in order to wipe out and remove a debit balance of $3,000, we make a credit. In that same amount, the balance of the account, $3,000. Now keep pushing the Tab key, and when QuickBooks moves to the third line, it balances the entry. Now, this is the moment that we choose the account we just created, because we know that $1,000 is the gain on the sale. So we click the pull down and we scroll down to the account that we made, gain on sale of bike. Now, it should be on the credit side because income is on the credit side, and this is very similar to normal income. But watch carefully. Gains on sales of personal non-business assets are taxable, and therefore you must include them. They are not exempt income, and this is the class choice you make when you are choosing the class, to make sure that this income is in fact included in your estimated taxable income. Now when you click Save and Close and just click we don't need classes for any balance sheet item. So we click Save Anyway, and you can see cash in bank is exactly the number we expected it to be, $12,681. Electronic bike has become 0 because we sold it, and if we scroll down, you can see gain on sale of bike is now $1,000. The interesting part is in the profit and loss. If you open the profit and loss and you scroll all the way to the bottom, you will see that the gain on the sale of bike is included in income, but it's not included in ordinary operating income because it is not part of what you normally do to earn money. So it made your overall income go up, but not your operating income or your net ordinary income. And let's also click Reports, Company and Financial, Profit and Loss by Class, push A for all and scroll down to the bottom. And you can see in the column that counts as taxable income and non-deductible expenses, the column that you're going to estimate your taxable income with, you will see at the bottom that the gain on the sale of the bike, I can make this column bigger, the gain on the sale of the bike is taxable, and it is showing up in the column that estimates our taxable income. To reinforce this idea, let's do a second example. Let's imagine on November 5th of 2016, we sold the couch for $1,500. So if the balance of the couch is $2,000, the loss on the sale will be $500. Let's create the loss account now. From the main menu, click List Chart of Accounts. Then in the bottom left, click Account New. Now this is not an expense, this is other expense. And it's other expense because it is not part of your normal operations, and it will go on the bottom of the profit and loss so that it does not affect how the profit and loss shows how you normally operated that month. Click Continue, and the name of the account is Loss on Sale of Couch. Save and close. Now, what will be the result after we record this sale? Well, cash goes up to $14,181 because we will have $2,000 more from the sale of the couch. The couch becomes zero because we don't have the couch anymore, and the loss from sale of couch will show up on the trial balance for the first time as $500. Let's take a look at how to record it. From the main menu, click Company, Make General Journal Entry. Now, the date was November 5th, and our bank account is increasing. So as we learned a moment ago, we will make a debit for the amount of money that we are physically receiving for the couch. Now, QuickBooks is trying to balance the entry, so I remove the money amount and I choose the actual couch. Now remember, we're putting the couch in the journal entry because it currently has a debit balance and we want to remove a debit balance. So the way to do that is to make a credit in the journal entry window for the amount of the balance. So we credit the couch $2,000, keep pushing the tab key, and now QuickBooks balances the entry by putting a $500 debit. And we know that the loss on the sale of the couch is the amount of $500. So the account we choose is the one that we just created. And it makes sense that it should appear on the debit side because the effect of a loss is similar to the effect of an expense. It lowers your income. And if expenses are on the debit side, it makes sense that the loss is as well. Now when we click Save and Close and say, oh, we're not finished, the most important thing to know is that this loss is not deductible because it is a loss on a sale of a personal non-business asset. So we must choose the other one. We must choose the non-deductible class this time, because a loss on a sale of personal property cannot affect the taxable income, or should not. So we click Save and Close, and don't worry about the other two accounts. They're not on the profit and loss. Click Save, and now you can see cash is exactly as what we expected it to be, $14,181. Couch became zero because we no longer have the couch, and you can see loss on sale of couch shows up for $500. On the profit and loss, you would have to scroll all the way to the bottom below net ordinary income to see how the loss on the sale of the couch lowered your overall net income for the month or for whatever time period you're looking at. And lastly, you can open Reports, Company and Financial, Profit and Loss by Class, A for All, and scroll to the bottom. Okay? Scroll to the bottom and notice that the loss on sale of couch is not deducted from your taxable income column. It's in this junk column here, and remember, this column means nothing. It's meaningless. All that means anything is the non-exempt deductible column, which is just a raw estimate of your taxable income, assuming you recorded everything properly.